Hey, David Zai Mortgage Guy. Do you have bad credit? This is an obstacle that keeps so many people from even trying to achieve home ownership, but I'm here to tell you, it doesn't have to be. I'm a loan officer of 17 years, and I work for the world's largest wholesale mortgage broker, and I've helped thousands of people with shaky credit find firm footing and land them in the home of their dreams. Today, I'm going to show you how to use an FHA loan to overcome your credit woes and how to repair your credit to ensure that you get the best rates. So let's get started. What is an FHA loan? An FHA loan is a government-backed mortgage option with more lenient credit score requirements than traditional loans. This really opens the door for many homebuyers or potential homebuyers who may struggle to qualify for a conventional loan or even a USDA loan. Young adult or recent college grads, self-employed individuals, like these are the perfect loans for people that want to buy a home but may have a little credit challenge. And we're going to really go into the credit challenges and how to overcome them and how FHA views them in this video. Let's start out with bankruptcy and the FHA loan. Bad credit reports aren't the only thing that an FHA loan can help with. If you've been through bankruptcy, it's not the end either. With FHA loans, bankruptcies do have a set waiting time. So on a Chapter 13, it is 1 year waiting period. And then on a Chapter 7, it is a 2-year waiting period. It doesn't guarantee an automatic approval. So here's the deal. If you were recently dismissed within 2 years of filing bankruptcy, your application is probably going to need a closer look by the loan officer instead of an automatic okay, because we actually have to go back and look at the last 12 months of payment history just to see why the bankruptcy was filed, why it was dismissed, why the credit challenge that led to the initial filing of the bankruptcy won't happen again. However, if it was dismissed more than 2 years ago with good credit, this is very likely to get an automatic approval, and it will not require a manual underwrite. The key thing is your payment history since the dismissal don't have a waiting period. However, we are looking to make sure that payment history is good and there haven't been any lates in the last 12 months. We talked about dismissals of bankruptcy. Let's now talk about a discharge of a bankruptcy. A dismissal says that, hey, I filed for bankruptcy. However, I decided not to complete the bankruptcy. And a Chapter 7 bankruptcy is I file it, I complete it, and then everything's kind of wiped off. You have a 2-year waiting period. However, if you have a very extenuating circumstance with a letter of explanation, we can review it at the 1-year mark. On a Chapter 13 bankruptcy, because it's on a payment plan, without dismissal or discharge, you have to have 1 year from the time of filing. And as long as we have trustee permission, we can actually complete the loan with an FHA and trustee permission. Now, let's go back to where the application may need a closer look, so that we can kind of identify the things that the loan officer and the underwriter are looking for. The first part is why the bankruptcy happened. Is it due to like medical issues? Is it due to financial challenges? Is it due to job change, relocation, a death in the family? Certain things definitely have different priority levels. However, once we have identified why the bankruptcy happened, we have to then go into what has changed to kind of avoid it happening again. Yes, we had a bankruptcy because I lost my job for a couple months. We didn't have a lot in savings, and that's what led to the bankruptcy. However, now we've got a nest egg kind of saved up, so we have some cash reserves. And with those cash reserves or any of the other compensating factors, which we'll cover later on in this video, that would help you justify a manual underwrite. So an underwriter can actually go into the file, look at it and say, yes, this is good. We'll sign off on the loan and I'll accept the letter of explanation. So now that we understand the bankruptcy, let's take a look at what the loan officer is going to be looking for to help you get approved. And the payment will have to include your PITI. So your principal, interest, taxes, and insurance. Now, this money has to be your money. It has to be in your account. It has to be liquid. And with those cash reserves, it could be the difference between an approval, automated, and having a lower interest rate versus a manual underwrite, which would require an underwriter to kind of go in there and check the compensating factors to approve the loan. Next, do you have a good payment history and are you making it on time after the bankruptcy? When my kids were growing up, there's light sockets all around the house, right? We put plugs in it, and if they put their finger into that light socket and they got zapped the first time, have they learned their lesson? Are they going to go back in, pull the light socket cover out and stick their finger in again? If they have, then they haven't learned. Same thing on a bankruptcy, okay? We want to see that you've made improvements and everything's gotten better. So the next thing that underwriters or loan officers are looking for is, do you have something positive going on for you financially, like a low debt to income ratio, or do you have a high debt to income ratio? The lower the debt to income ratio, the higher the likelihood of getting a manual underwrite. Bankruptcies can definitely stay on your credit report for 7 to 10 years. However, if the bankruptcy is satisfied by a complete discharge, at that point, if you have the waiting time and if you have reestablished your credit, that will certainly build your credit score back up and improve your chances of getting an approval. So on a Chapter 7 bankruptcy, there's a 1 or 2 year waiting period. 1 year with an extenuating circumstance, 2 years with a regular discharge, and 12 months of payment history up to the time of application. Everything's been paid on time. On the Chapter 13, it does require that you've made your payments on time because you're paying your creditor back in the repayment plan. And having that payment history paid on time will improve your chances of having the trustee give you permission to go ahead and apply for a mortgage. Let me go ahead and give you an example of a customer that I recently helped. The customer, they went through a tough financial period due to divorce and new marital debt with their new spouse. They had to file a Chapter 7 bankruptcy. However, my customer diligently rebuilt his credit after 2 years. He was never late again on any credit cards, never late on any installment loans because he started setting up automatic payments. He did qualify for an FHA loan, and by the time he came and saw me and got that new loan, his credit score had improved to a 640 credit score. He's now a homeowner. The moral of that story is, if you file the bankruptcy, it's totally not the end of the world. Reestablishing credit is really important, okay? You have to reestablish some sort of credit, and if you want it to be affordable credit, I would highly recommend a secure credit card. Let's go ahead and jump into judgments and collections on FHA loans. Don't let these outstanding debts hold you back, okay? What do I mean by that? These unpaid judgments and collections definitely lower your credit scores. However, depending on the type of collection or judgment they are, some of these should not even show up on your credit report. So if they're medical, based on HIPAA rules, they should not be showing up on your credit report. Pulled a credit report yesterday. One of the collections that showed up on my borrower's credit report was a medical collection. So he's actually in the process of getting this removed off of his report. And with that removal, based on my credit analytics, we should get a 60-point improvement on his credit score. However, the way that FHA views judgments and collections and charge-offs is just like this. On collections, you cannot have more than $2,000 of consumer collections, okay? Basically anything that's not medical related. All medical collections do not have to be counted, and like I said, they can get taken off of your credit report. On judgments, if there are liens on a property, then we cannot close on the loan prior to settlement of the lien. However, if it's a judgment and you're on a payment plan and it does not put a lien on your property, we can qualify you based on the payment plan. And then finally, on charge-offs, these are actually written off debts that can still impact your credit. However, with the charge-offs, they do not have to be counted. So just to recap, with $2,000 or more in consumer collections, they have to be paid down below $2,000 total collectively. If they're medical collections, they do not have to be counted, and charge-offs absolutely do not have to be counted. And judgments, we can close as long as they're not a lien and there's a payment plan set up to pay it off. So another point on the charge-offs is, yes, we don't necessarily need you to pay the charge-off off before buying a house. However, it will still hurt your credit score because even though the consumer has charged it off, it's still technically viewed as a collection. Here's the tricky part that not a lot of people are aware of. With all of these judgment, collections, and charge-offs, it's not always clear whether fixing these issues will actually help your credit score. It can depend on how old they are and other factors. It could depend on if you're just settling it or if you're settling for deletion. So don't try to fix the credit on your own. Talk to your loan officer first. They can run a credit simulator to see if dealing with these debts in the way that you want to deal with them is actually going to improve your chances of qualifying or deny you. Here's an example of a customer that I helped. We had a customer with some credit card charge-offs from his college years. He contacted the credit card companies, negotiated settlements, and paid them off since they were newer non-medical collections. The status on his credit report actually changed to a paid charge-off, and because of that, that actually dropped his credit score, making him non-FHA eligible. However, what I advised him to do was you gotta call the creditor back and talk to them on the phone and see if we can get a letter showing that, hey, because I paid for this, I wanna get this deleted off my credit report without getting credit repair involved because we were already under contract. Luckily, we did get the pay for deletion letter, and his credit score actually jumped over 120 points, getting him a better rate because we were able to get an automated approval. And this actually saved him, because of the automated approval over a manual underwrite, over 1.3%, which equals to $6,400 in closing costs. So a huge savings and a huge win for my borrower. Let's go ahead and jump into foreclosures and short sales. Foreclosures and short sales definitely are one of those things that will affect you probably the most when it comes to all the different hardships that we've talked about so far. However, it is not the end of the world. FHA loans have help for you, but But here are a few things that you need to know first. First of all, foreclosures and short sales will stay on your credit report up to 7 years. Generally, you will have to wait 3 years after the short sale or the foreclosure, and you'll also have to make a mortgage or other installment loans on time for the last 12 months after the short sale or foreclosure, and the waiting period is required. However, there are special situations where we can have extenuating circumstances. So after 1 year with an extenuating circumstance, acceptable circumstances would be act of nature, death, or major medical issues that may have caused a loss of income. So if you have any specific concerns, we can certainly do a more thorough review of your loan through a process called manual underwriting, and a lot of mortgage companies can do this. So what we would do is we'll gather all your information up front, and we will actually submit it into an underwriter, let them review the letters of explanation and go over the extenuating circumstances and see if this could be something that will be accepted by FHA and the FHA underwriter. If you have a foreclosure that was actually included in the bankruptcy, this is where things kind of get trickier. So in the past, FHA said that, hey, if it's included in the bankruptcy and not the foreclosure itself, so a 2-year waiting period instead of 3. However, FHA actually sent out an update on this guideline recently, and now we have to go off of the foreclosure guidelines instead of the bankruptcy guidelines, and this information has not been updated in the official handbook yet. If you've had a foreclosure, the waiting period may still apply, even if you included the foreclosure or the mortgage in the bankruptcy. So remember, building back after a challenging situation takes consistent hard work and time. You have to focus on making sustainable changes over time to succeed. 3 years later, with a good credit score and proof of stable income, you'll be ready to obtain your FHA loan and buy your dream home. Let's now talk about late payments and how showing a pattern of improvements will give you a brighter future. We're talking about late payments in 2 different segments, okay? We're gonna talk about late payments on regular revolving accounts and then installment accounts and how they're different. Late payments on credit cards, loans, and other accounts can significantly damage your credit score, but working with an experienced loan officer and showing good faith efforts to fix these mistakes can certainly go a long way. If lates ever get to 60 or even 90 days late or even more without any good extenuating circumstance, your loan definitely has a higher chance to be manually downgraded and denied, even if you were told that you were approved up front. It's really important to catch up on any past due payments and establish a history of on-time payments moving forward. This definitely demonstrates responsible credit behavior, but David, what if I'm late on my mortgage? It's not the end of the world, but here's what you need to know about that. If you recently had a late payment, your application may need a closer look, and that's called a manual underwrite, which will cost a lot more in terms of the cost. However, this still gets you to your home, and then you can actually work on your credit later on. How bad were the late payments? This is really gonna determine whether you can get the loan or not. It depends on how recent and severe they were. So let's go ahead and rank good, bad, and really bad. Really bad means that, hey, if you have these, it's going to be a really bad manual downgrade, and there's a really high chance that you're going to get it denied. So really bad would be 3+ late payments over 30 days, or 1 30-day late over 30 days, and a 60-day late, or 1 90-day payment within the last 12 months. These are really bad, and it shows the underwriter that you are not responsible with your credit, and 9 times out of 10, this will be manually downgraded without an extenuating circumstance and denied. If you had a forbearance, and I know this happened a lot during COVID, especially on mortgages, if you've made less than 3 payments since the completion of the mortgage forbearance, we cannot do any financing for you. After the forbearance is actually completed, you have to make at least 3 payments before we can do financing. Now let's talk about cash out refinances. These are a lot stricter because you are taking cash out. We will want to know why you're taking cash out, and you'll probably need a perfect payment history to get an automated approval. However, if you had 1 or 2 30-day lates on credit cards, it's fine. If you had it on an installment loan, we will have to take a closer look. If your application does get downgraded for a manual underwrite, you'll typically need to show 12 months of on-time payments unless there's a really good reason for the late payment and why it won't happen again. Remember, avoiding late payments will save you time and money when applying for an FHA loan. Let's talk about the FHA loan requirements and manual underwriting. What is required? If you have a 500 credit score to a 579 credit score, you will need 10% down to do an FHA loan. However, if you are over 580, then all you will need is a 3.5% down payment. And most banks and retail lenders are going to stop you right at a 620 or 640. So it's really important to shop around and know there are other lenders out there that can do these manual underwrites. So shop with a wholesale mortgage broker and shop with one that has a lot of options. Continuing on the manual underwrite, this will involve a loan officer assessing your overall financial picture, including your debt to income ratio, which would require you to provide your income, your assets, and your liabilities, your employment history, and the amount of money that you have saved that's going to go towards the transaction, and cash reserves after the transaction. You have to demonstrate stable income, responsible credit management can certainly strengthen your application even with a lower credit score. Let's now talk about something that's going to cost you time and money, and the reason why most FHA loans fail: manual underwriting. If we have to get a manual underwrite for your loan, something's wrong. We'll have to talk about what you have to do to get a manual underwrite approved and how to avoid one in the first place. What triggers manual underwrites? Number one is missing information. Make sure you have all of your documents your lenders need, okay? Don't hold back on anything. Make sure all the documents, if it's bank statements and it's like 6 pages, and on the bottom of the pages it's labeled 1 of 6, 2 of 6, 3 of 6, don't pull any documents out because they're blank, okay? The lender will have to verify everything, and not having all of your documents will delay the automated approval process. If you have any disputed accounts, okay, disputed credit accounts are definitely not good, especially if they're exceeding $1,000. It's best to resolve them before applying, because all disputes will have to be removed off of your credit report, and it will temporarily lower your credit score. If you've had a recent bankruptcy, if your bankruptcy discharge is less than 2 years old, your application will likely need a manual underwrite. So it's really important that you have all of your bankruptcy documents, all of your payment history, and if there's a trustee, you provide the trustee contact information as well as your attorney's contact information to your loan officer, along with a payoff of the bankruptcy if we are going to be paying it off for a cash out refinance. Debt and income is really important in an automated approval process, and especially in a manual underwriting process. Undisclosed mortgage debt is one of the biggest red flags that can happen on a credit report. So it's important to be upfront about all of your debts, especially mortgages. Having a delinquent mortgage and finding out at the last minute, especially if you've had lates in the last 12 months, will likely require a manual underwrite and could potentially have your loan declined. Another big thing is declining business income. For all of my self-employed borrowers out there that want to get an FHA loan, if you've had a significant decline in income in the last 2 years, we will have to use the lower of the 2 years. And if the decline is significant enough, we may not even be able to use any of your income. Now, why is this important with the decline in income? It's because we're looking at debt to income ratio. This ratio actually compares your debt payments to your pre-tax income. That lower debt to income ratio is certainly better. And here's a breakdown of the maximum debt to income ratios that are allowed in different situations. If you have a credit score of 500 to 579 or no credit, the maximum debt to income ratio on a manual underwrite is going to be 31% for your housing expense only and 43% for all of your total debts. Let's have an example. You have a borrower that has $10,000 a month in income before tax. Their housing expense is going to be $2,000. So the debt to income ratio on the front end will actually be 20%. However, if they have $1,000 in regular consumer debt on top of that, now we're looking at $3,000 a month. So their back end debt to income ratio will be 30%. So in this situation, with a customer that has a 500 to 579 credit score or no credit, they will be well within range of the 31-43 debt to income ratio to qualify for a manual underwrite. If you have credit scores that are 580 or above, the maximum debt to income ratio is also 31 for the housing expense and 43 for the total debts, but with some exceptions such as compensating factors, you could actually potentially qualify for even higher debt to income ratio. If you have verified cash reserves, a lower housing payment than your current rental payment, or a slight increase, or even additional income that is not being used to qualify in your mortgage, let's say a second job, but you haven't had 2 jobs for 2 years. However, you've had 1 job for 1 year and 1 for 2 years. At that point, the debt to income ratio can actually go to 37% for the housing expense and 47% on the total debts. That's with one compensating factor. The other compensating factor would be no discretionary debt. If you have no discretionary debt, that means no consumer debt other than just your mortgage. At that point, FHA will let us go to 40% on the front end and 40% on the back end. Here's the kicker. If you want to go even higher on the debt to income ratio, at this point, you'll have to have 2 or more compensating factors. The debt to income ratio can actually reach 40% for the front end housing expense and 50% on the total debt. But remember, by avoiding these situations and potentially improving your credit score up front, you can actually increase your chances of getting an automated approval with a more favorable interest rate. So talk to your loan officer for more personalized advice. Now that we've talked about the basic level of FHA approval, let's go into some high-level additional tips. How do we improve your credit score? As I mentioned many times in this video, credit score counts. So we always pay down our existing debt, especially credit card utilization. When you have credit card utilization over 50%, even at 50.01, that will drop your score. And also avoid opening any new accounts before applying, because even though you're transferring accounts in between just to lower that utilization, it's going to show that you've opened up new account, and that shows the credit score models as well as the underwriter that, hey, we are now grabbing for more debt to qualify. And that's definitely no bueno. The second tip would be saving for a down payment. While FHA does allow for a minimum of 3.5% down payment, a lot of times we can actually play with the file and massage it, and slightly improving that down payment factor from 3.5 to maybe 5% or 7 or 10 actually can reduce your loan amount, give you a better monthly payment, and take that manual underwrite from a manual to an approved eligible and save you money. Always, always, always find a qualified FHA lender. Find one that is experienced. Find a wholesale mortgage broker, because based on 2021 HMDA data, we're able to save consumers between $8,000 and $11,000 over the life of the loan when using a wholesale mortgage broker over using a retail lender or a bank. You have to understand that with these different lenders, we have specific requirements, and certain lenders, especially on the retail and the correspondent side, they're going to have overlays. Overlays mean, hey, we have these guidelines, however, we're going to have a halo around these guidelines that are in addition to these regular FHA guidelines. We will need to make sure that you can fulfill these additional requirements as well. So if you've learned something so far, subscribe to the channel. I actually have complete guides on every single different loan, FHA, VA, and USDA, and a playlist breaking down every one of them. I'll teach you the same tips and tricks I use every day to help my clients secure their dream home. Be sure to check out the link in the description below. But for now, let's get back to the video. Just a recap here. Bankruptcy, the waiting period is 1 to 2 years after discharge. That's really important. On judgments and collections, it's really important that when you're negotiating for a pay for deletion. On charge-offs, even though it doesn't affect your approval, it does affect your credit score. So getting these removed is going to be key to having that manual underwrite turn into an approved eligible on an automated approval. On foreclosures and short sales, it's really important to maintain that good credit after those bad situations have already happened. And on late payments, it's really important to catch up and reestablish that on-time payment history. So if you're ready to explore FHA loans in more depth and see if they're the right fit for you, this channel has a wealth of resources. For a comprehensive breakdown of everything you need to know, be sure to click one of the links down below, and don't let credit challenges hold you back from achieving your dream of home ownership. With the right approach and FHA loans, you can unlock the door to your future. I'm David Zai, Mortgage Guy, and I'm out.